Hi everyone, my name is Adrian and welcome to the second video in my beginner's guide on passive income investing. In this video, I'll explain what a dividend actually is and how they work. So dividends are assets that are paid out of the profits of a corporation to its shareholders, which is us. So companies that pay out dividends are usually well-established and reliable companies that have been around for a really long time and consistently make profits in order to give it to us, the owners. So this is important because as a passive income investor, the main thing you want is consistent and reliable income. We couldn't care less about any stocks that don't give a dividend, as we would never buy that company individually. Companies that don't pay dividend are typically riskier, like penny stocks, or they're newer, unprofitable companies. I'm not saying all companies that don't pay a dividend are bad. Some good ones like Amazon, Google, or Tesla, for example, don't pay out dividends because they reinvest all their profits in research and development. And as you can see from their share price, they're pretty amazing companies. So I do invest in these types of companies. I work in technology, so I love tech companies, but I don't invest in them individually. How do I invest in them? Well, I own several funds and ETFs that hold some of these companies. Don't worry, in the next video of the series, that's where I'll discuss the different types of dividend stocks, including those types of funds. Another important distinction is taxes. So income from dividends are taxed less than capital gains, especially eligible dividends. So I'm a Canadian resident, and when I buy shares of a Canadian corporation, the dividends are deemed eligible. So the government of Canada basically gives me an added tax credit or tax break on the income I receive. This basically encourages Canadians to invest in Canadian companies, and the same thing in the US. So I'm not an accountant. At this point in the series, I'm not going to get into all the details of the income tax implications, but you could always read up on this some more. I will put a link in the description of the video so you could read further on all the tax implications surrounding dividends. The bottom line is that dividends are much more tax efficient than capital gains. Less tax, more money in your pocket. As simple as that. Okay, so now the fun stuff. The first thing to know when you buy a dividend stock, the first thing you need to know is 1, what the annual dividend rate is. This is a dollar amount. 2, what the dividend yield is. This is a percentage. And 3, the least important thing is how often the dividends are paid out. So typically they're either paid out quarterly, which is every 3 months, so you get 4 dividend payments a year, or monthly, which is my personal favorite, as you get money every single month. So the best way to understand this is to show you an example. So let's look at a very well-known Canadian stock, BCE, better known as Bell Canada or simply Bell. So Bell Canada is basically the biggest telecommunication company in Canada. So if you're in the US watching this, it's very similar to an AT&T or Verizon. So a very well-established and reliable company which keeps making profits for its shareholders. So let's take a look. Alright guys, so let's check out Bell Canada as an example. So right now the share price of Bell Canada is $62.51, and if we scroll down and look at the fundamentals of any stock, you'll get always the same thing. So 2 things that will always appear will be the dividend yield and the annual dividend rate, the 2 things that I just discussed. So the annual dividend rate for Bell Canada is $3.33, that's per share, and that's CAD, which means Canadian. And the dividend yield is 5.33%. Now, how is 5.33%? How did we come up with that number? Well, it basically, all you need to do is divide the annual dividend rate by the share price. So if we take 3.33 and divide it by the share price of 62.51, times 100, you always got to do times 100. And you have 5.327. So if you round that up, it becomes 5.33%. Pretty simple. So what does that dividend yield mean? Well, basically it means that if you invest $10,000 in Bell Canada right now, you will lock in basically a dividend yield, or think of it kind of like an interest rate of 5.33%. So that's pretty good. It's much better than your grandmother's savings account. So you should be aware of 3 important dates surrounding dividend payments. 1 is the X date, 2 the record date, and 3 the payment date. So the X date is always 1 business day before the record date, And in order to qualify to get the dividend, you need to own or buy the stock 1 business day prior to the X date, as you need to be the official owner of the shares on the record date. For example, if the X date for an upcoming dividend payment is March 13th, the record date would be 1 day later, which is March 14th. You would need to buy the shares on March 12th in order to qualify to receive the next dividend. The reason is pretty simple. When you buy a stock, it takes 2 business days for the settlement between the broker and the individual to be finalized. That's why you need to buy the stock on March the 12th, which is 2 days prior to the record date of March 14th. Confused? Let me summarize one more time. So on the record date of March 14th, you need to be the owner of the shares to qualify for the next dividend payment. Since it takes 2 business days for the transaction between you and your broker to be finalized, you need to buy the stock at the very latest by March 12th, which is 1 day prior to the X date and 2 days prior to the record date. So the third important date, and it's the best one of all, is the payment date. And it's exactly what it says. It's the day that you get your money. So there's a reason why I chose those dates. Let's go back to our example of a stock, Bell Canada. So if you scroll down to where we were before, you could see the dividend yield, the annual rate like we discussed, and right under that you have the ex-dividend date, and it's March 13th. The payment date when you get your money is April the 15th. So let's look at the dividend payment in details. If we just go to events, click on dividends, and you can see here, this is what I'm talking about. So the event date is basically when the company declared that they're gonna send out a dividend. We don't really care about that date, it has little consequence. The dividend per share is basically what the dividend payment is gonna be. So here it's 83.25 cents. Why is it 83.25 cents? Well, it's because the annual dividend is $3.33, and because they pay it out quarterly, you got to divide it by 4. So 3.33 divided by 4 gives you 83.25 cents. And like you can see here, the X date is March the 13th. So in order to qualify for the dividend, which is going to be paid out on the payment date, April 15th, you need to buy the shares 1 day prior to this, which is March 12th. So that is pretty much the basics of what a dividend is and how they work. I tried to explain it best I could as if I was talking to somebody who's completely new at this. If you're still confused or have any questions, let me know in your comments below. Or you can just do what everyone else does now and just Google it. Trust me, it's not that complicated. So in the next video, I'll discuss the different types of dividend stocks. So thanks for watching, guys. Please hit the like and subscribe button if you haven't already done so. And if you have any questions, don't hesitate, just post them in the comments below. See you next time.